Microsoft just reported its latest earnings, and despite strong results, the stock dropped nearly 10%. So, what went wrong? Revenue was strong, cloud and AI demand is accelerating, Azure is still growing fast. And yet, investors weren't convinced. Microsoft reported $81.27 billion in revenue, beating expectations of $80.31 billion. Earnings per share came in at $5.16, well above estimates of $3.92. In Intelligent Cloud, revenue reached $32.91 billion, ahead of estimates. Commercial cloud revenue totaled $51.5 billion, and productivity and business processes delivered $34.1 billion, also above expectations. Across the board, Microsoft beat estimates, and yet the stock still sold off. Looking ahead, Microsoft expects third-quarter revenue between $80.65 and $81.75 billion, pointing to continued growth. Intelligent Cloud revenue is guided at $34.1 to $34.4 billion, with Azure growth of 37 to 38%, showing demand remains strong. Productivity and business processes revenue is expected to reach $34.25 to $34.55 billion, driven by Microsoft 365 and Dynamics. More personal computing is expected to be weaker, with revenue between $12.3 and $12.8 billion. On the cost side, Microsoft said operating expenses will remain elevated at $17.8 to $17.9 billion, as the company continues to invest heavily in AI. As a result, cloud gross margin is expected to stay around 65%. Management made it clear on the earnings call that demand for AI and cloud services is not slowing. Growth is being limited by capacity, not demand. Microsoft said Azure growth could have been above 40% if all new GPU capacity had been allocated to Azure, but capacity is being shared across Microsoft 365 Copilot, GitHub Copilot, and internal AI development. The company defended its sharply higher capital spending, saying investments in GPUs, data centers, and AI infrastructure are intentional and focused on long-term returns, even if margins are pressured in the near term. Microsoft also disclosed that commercial backlogs surged to $625 billion, up 110% year over year. About 45% of that backlog is tied to OpenAI, while the rest is broad, diversified, and growing strongly. On AI monetization, adoption continues to accelerate. Microsoft now has 15 million paid Microsoft 365 Copilot seats, up 160% year over year, and 4.7 million paid GitHub Copilot users, up 75%. So why did the stock drop? Not because earnings were weak, but because expectations were higher. Investors are focused on rising AI spending, margin pressure, and the timing of returns. Even with nearly 40% Azure growth, guidance did not point to immediate acceleration, and margins are expected to remain under pressure. In short, this was a timing issue. Strong long-term AI potential, but uncertainty about when spending turns into higher profits. Personally, I still see Microsoft as a long-term buy, given its leadership in cloud and AI. That said, I wouldn't go all in here. With heavy AI spending and margin pressure, more volatility, and even further downside is possible in the short term. My approach would be dollar-cost averaging, building a position gradually instead of trying to time the bottom. Microsoft's fundamentals remain strong. The AI opportunity is real, but patience matters. Thanks for watching, and I'll see you in the next one.